Hello, everybody. Good morning, good afternoon, or good evening, wherever you are in the world today. My name is Alex Tapia. I am the president and founder of Aviation Retirement Strategies. Welcome to the Pilot Money Podcast. Today is April 23rd, and here's a quick recap of what's been happening for the year. So far, the Fed has decided to keep interest rates higher for longer, which has basically volatility creeping back into the markets, and inflation seems to be sticking around for longer than we expected, along with a strong labor market, solidifying the notion of high interest rates for a longer period of time. Also, bond yields have gone up because of this, while the stock market has pulled back due to the overbought conditions that we've been experiencing in the last few weeks. Wall Street sentiment can change pretty quickly on new information when we decipher that. And during the fourth quarter of the last year and into the beginning of this year, we've had what some might call a Goldilocks economy, where inflation really hasn't been too hot and growth hasn't really been too cold. And really, it's an ideal state for the economy. And of course, the stocks tend to do very, very well during this type of an economy, which is what we've seen the last quarter and basically this quarter as well. In Q1 of this year alone, the S&P 500 posted a gain of 10.2%, which included 22 record highs and a maximum pullback of only 1.7%. However, as inflation comes in hotter than expected in April, it took steam away from the market, driving the S&P 500 down 5.5% as of April 19th, which was only a few days ago. Now, of course, the markets can't continue to go up in a straight line, so a pullback is healthy for a good market, and we have no reason to believe that this pullback is anything really other than that. However, should we continue to get higher than expected inflation, the Fed could decide to keep interest rates higher for a longer period of time. But for now, we're going to have to wait and see what happens. Now, unfortunately, higher interest rates also come with higher bond yields, which has also a negative effect on bond prices, which accentuates the negative effect of a market pullback if you have high exposure to fixed income in your portfolio. Now, obviously, the more conservative the portfolio is, the more fixed income exposure you will have. For stocks, keeping rates higher for longer also means stocks could be under pressure, as some investors will feel that they can get better returns in fixed income, enticing them to move away from equities into a more stable environment. This is what was the catalyst for the pullback in the markets, but to date, we have not seen any reason for any concern or need to make any significant changes to our investments. It's important to remember that pullbacks, or even market corrections, which is a market correction of 10% or more, are part of a completely normal bull market. They provide an opportunity for fundamentals to catch up with prices, reset overbought conditions, suppress overly exuberant sentiment, and also provide another potential re-entry point into this bull market. Our asset allocation insights dictate a neutral stance, meaning that we're not going to be looking to make any changes right now. And because of the stronger dollar, we're also maintaining preference over U.S. stocks versus international stocks, as we've actually been doing for quite a while now. Obviously, we keep a very close eye on the markets as we progress, and we'll let you know of any potential changes to our outlook. But should you have any questions about your specific portfolio, as always, please do not hesitate to give us a call anytime so we can discuss your specific situation with you over the phone or in person, or maybe via a Zoom call or something like that. For now, I hope this clarified a couple of things for you. We look forward to hearing from you. And as always, have a great day, and we'll be talking to you soon.